Hi there, welcome to a weekly segment of the Cytonn Report. I'm your host, Teresia Kengara. Now, we all know that the banking sector has been facing a myriad of challenges, from the interest rate capping to the massive job cuts. We get to discuss about the banking industry in light of the recently released Banking Report by Cytonn Investments. Now, with me on the show is Ian Kagiri, an investments analyst. He's here to shed light on the report. Ian, karibu.
Thank you for having me.
And maybe to start us off, maybe give us a brief overview of what the report says.
We undertook to conduct our research on the banking sector with the most recent financial results for the first half of 2018. So our main aim was to identify the financial health of the banking sector and identify viable investment opportunities for anyone wishing to make an investment into the banking sector.
And maybe you could tell us about some of the metrics that you were using during the research.
So the ranking of the players in the banking sector was conducted using two sets of metrics. Now, the first is what we call the franchise value ranking. The franchise value ranking tries to determine the financial health of these companies that are in the banking sector. Now, the other set of metrics that we use are what we call the intrinsic value. This is ideally the value that a shareholder would get while investing in these banks. So we weight the two matrices at a ratio of 40 and 60%, and we come now with a composite value.
And you talk about KCB being the best performing bank according to your report. Maybe give us a brief overview of how the report actually details all the other banks.
KCB emerged at the top on a composite ranking. It has been the top bank for the last 2 years, since full year of 2016. And the key things that have made KCB to be the top ranking bank, they have a very strong corporate governance. We remember we say that with a good corporate governance, a company is well bound to perform good in their financial results. So KCB has also been aided by, they have a very strong both local and regional presence. So they have a wide coverage in terms of clientele, like cover both retail, corporate. And these has helped the bank perform better across the franchise value metrics. So when you look at KCB's operating efficiency in terms of their cost to income, they are actually the second best bank. When you also look at things like the loan to deposit ratio, they rank among the top banks. And also, ideally, when you look at the profitability, they had the second best return on equity. So when you now come and look at the intrinsic valuation, they rank again as the third best bank. So when you combine those two, then KCB emerges as the top most performing bank.
How have the banks in the industry been receptive of your report?
The good thing is that most of this information that we normally use to conduct our research is made available to the public once the banks are mandated to release their financials to the public by CBK rules. So we use those financials. So when conducting the research, we normally send banks with letters for them to confirm the matrices that we are using, whether they are correct. And so once they give us the go-ahead, we go ahead and now proceed to conduct the analysis.
From the research, what would you say is the forecast when it comes to banking sector in Kenya? What does the future hold?
We know that the banking sector has been fraught with a lot of challenges since the capping of interest rates back in 2016. It's now exactly 2 years when the law has been operational. And what we noted was that there was a compression in terms of interest income that banks would receive from the loans. So banks sought to mitigate these reduced or rather compressed interest income by venturing into other ventures, mostly focusing on the non-funded income. And also in the process, banks also sought to reduce their overall operating expenses. So we did see a lot of staff layoffs. We did see a lot of branch closures. So banks adjusted their operating or business models to come and navigate this tough operating environment. So going forward, we see a lot of focus mainly on the non-funded sources of income, things like the fees and commission on loans, the other fees and commissions, and also the venturing into bank assurance. We've seen a lot of banks venturing into bank assurance. And also with the increased uptake of the alternative channels of product distribution, we've seen a lot of mobile banking apps, internet banking. So this adoption of these alternative channels has aided banks in earning the more transactional income from these. So we've seen a lot of NFI boosting strategies by banks, and also cost containment. So we believe that for the banking sector, the outlook looks positive, because banks have realized that growth stability will be aided by product and revenue diversification as well as cost containment. For the banks that did not perform well, a key thing we noted was that these banks were incurring high operational expenses. A key example is we had housing finance, which ranked last in our ranking. So when you take a look at housing finance's cost to income ratio, it's at 99.3%. So ideally it tells you that costs take up 99% of the bank's total operating income. So the bank has no room for achieving profitability under the high cost regime. When you look at the banks that have been performing well, you note that the banks have also had compressed net interest incomes. So these banks earn less interest, because when you look at their loans, they have actually been declining over the years. And another thing that is worrying is that these banks have also been their deposits have also been declining. So it tells you that people have some skepticism about having their deposits in these banks. So ideally we think that that may have contributed in some way to the sort of poor performance here.
In this first half of the year, what are some of the themes that have shaped the industry or the banking sector?
Some of the key themes that we did see shaping the performance of the banking sector for the first half of the year. First was there was a lot of movement in regulation. So we did see the National Treasury coming in with the draft Financial Markets Conduct Bill, ideally a bill aimed at promoting credit consumer protection. There was also the proposition of the banking sector charter by the central bank to improve service provision by financial services players to their clients. A key thing again is still the interest rate cap continues to have effects on players in the financial services sector, more so the banks, in terms of reducing credit extension mainly to the private sector, which is mainly comprised of the micro, small and medium enterprises, the MSMEs. So regulation still remains a key part of the performance of the banking sector. Another key theme was that asset quality of the industry seems to be on a worrying trend. We note that when you look at the proportion of the non-performing loans to the loans that we have in the sector, you find that the proportion has been increasing, currently at 10%, rising from 7.7% in half one of 2017. So banks, we feel that going forward, this will be a key area of focus in terms of containment of their asset qualities to try and mitigate the deterioration. Another key theme we note was that banks have been diversifying their revenue sources. So we did see banks diversifying their revenue sources, mostly leveraging on the alternative channels of distribution, and also in terms of venturing into bank assurance. We did see we've seen KCB partnering with Sanlam and other ventures. Banks have been venturing into bank insurance basically to boost their non-funded income. So revenue diversification is again was a key theme that we noted, while also banks trying to leverage on the increased uptake of these alternative channels of distribution. We saw Barclays launching their Timiza app, which is a mobile lending, which also provides other services like micro insurance purchasing, payment of utility bills. We also saw HF launch their own platform, which was dubbed HF Wiz, again another mobile channel. We also saw Equity launching FinServe, which was mainly to drive financial services focused innovations. So there's a lot of activity towards revenue diversification, and at the same time there's also a lot of focus on improving the operational efficiency. So these alternative channels, we believe, will be the key way through which banks will likely both boost their non-funded income, non-interest income, and also reduce the operational expenses, and in the process improve the sector's operational efficiency. For a long time now, the focus has been purely on financial inclusion. I like to think of it like the quantity of financial inclusion. We normally talk of 77% of the Kenyan population being within the financial services. However, I do feel that a key focus area going forward will be in the quality of these financial services that we get. So Kenyans are likely to demand better quality financial services, and so we will cease from looking at it in terms of the quantity of financial inclusion, and more look at it at the quality of the financial inclusion. So all in all, we expect the performance of the banking sector to be an improvement compared to last year, and the sector will likely continue to outperform all the other sectors of the economy. So these will be aided by both the strong nature of the banking sector in terms of resilience of any new challenges that the banking sector encounters, and also due to the fact that currently the economy is at a better place compared to last year. So with the relative calm in the economy and improvement in other macroeconomic conditions, so we do expect that performance will likely to be better for the banking sector going forward.
Okay, thank you, Ian.
Thank you.
There you have it. Until next time, kwaheri.